Dear taxpayers, how does it feel when you get a budget in the AMRUT-KAAL of India? 75 years of India's budgeting history made the Honorable Finance Minister Srimati Nirmala Sitharaman present a historic budget of 2023. This is Mukesh Patel, who has had the privilege of analyzing union budgets starting from 1977 for almost 46 long years. And as my memory stretches back, I would call this as one of the most historic budgets ever. A budget bold and beautiful. A budget which has endeavored to give to income tax payers PANCHAMRUT in the AMRUT-KAAL. What is that nectar which is so sweet? Anything comparable that comes to my mind is Mr. P. Chidambaram's then described as dream budget of the year 2008. At that time, in the year FY 2007-8, on a taxable income, India's taxpayer had to pay income tax of rupees 4,52,067, which worked out at an average tax rate of 30.14%. In the historic dream budget presented by Sri P. Chidambaram, with the reliefs that were granted by him in terms of the rationalization of tax slabs and raising of the tax exemption limit and lowering down of the maximum marginal tax rate, the income tax slided down to rupees 4,02,215, making it an average tax rate of 26.81%, which in terms of percentage worked out to 3.32%. However, the tax saving as percentage of the preceding year, considering the tax saving of 49,852 on the income tax liability of 2007-8 in a single year, then FM P. Chidambaram gave a relief of 11.03% to individual income tax payers. Now compare this with the budget of Srimati Nirmala Sitharaman. In FY 2022-23, on taxable income of 15 lakhs, the income tax payable was rupees 1,95,000, working out to an average tax rate of 13%. In a single year, this bold and beautiful budget has offered a relief of 39,000 rupees, bringing the income tax payable on the same income of rupees 15 lakhs at 1,56,000, which works out to an average tax rate of 10.40%. However, compared to the tax saving as percentage of the preceding year, the figure works out to a whopping 20% tax relief, which is perhaps the highest ever in a milestone budget of any FM, even surpassing far beyond the 11.03% of the dream budget by Sri Chidambaram. Budget 2023 presented by FM Nirmala ji has perplexed taxpayers, media, tax experts as well into this never-ending debate of old versus new. What is right for you? There was a perception when the old tax regime was offered with a substitute by the new tax regime 4 years ago by the very same FM, whether old was gold or new was right for you. During these 4 years, the new scheme as it existed, as it was proposed then and as it existed in FY 22-23 really could not take off. And therefore, the challenge for the FM this time was to come out with some thinking out of the box to ensure that the tax system is made simple, tax rates rational, in a regime where there are minimum of exemptions and deductions, resulting into a scenario where there would be hardly any scope for tax disputes or even tax avoidance by some mischievous taxpayers. And that seems to have been substantially achieved with some very pragmatic and imaginative tax proposals in the revised and proposed new tax regime. So today we are going to talk about the existing new tax regime in comparison to the old tax regime and benchmark it with the proposals of the new tax regime as proposed for FY 23-24, that is assessment year 24-25 and onwards. And this is not simple as it is said. Therefore, I have endeavored to make a small PowerPoint presentation in this video offering some practical case studies and with some meaningful graphics so as to enable you to understand what is the impact of the proposed amendments in the personal income tax rates and how much an individual taxpayer would truly stand benefited. Whether old is really going to remain gold, or maybe for the taxpayer, new may be right for you. For understanding impact of key changes in personal income tax rates, let us look at the old versus new tax regime for AY 2024-25 and onwards. First and foremost, keep in mind that the new tax regime is now proposed to be the default regime. Currently, the old tax regime is the default regime under section 115 BAC, and the eligible taxpayer, individual or HUF, is required to exercise his option for selection of the new regime. Effective assessment year 2024-25, the new regime will become the default regime not only for individual or HUF but also for an association of persons, that is AOP, except cooperative, body of individuals, BOI, or artificial juridical person, AJP. An option for the old regime will need to be specifically selected by the taxpayer. The tax rates under the proposed new tax regime have been revised. Personal income tax rates for old tax regime will continue unchanged. Effective AY 24-25, the personal income tax rates under the proposed new tax regime revised are as under. Until 3 lakhs, 0%. Kindly note, the basic exemption limit has been raised from 2.5 lakhs to 3 lakhs. However, this will be applicable only in case of the new tax regime. So for the old regime, the earlier limit of 250,000 will continue as the basic exemption limit. In the first slab, the slabs have also been restructured in 5 in place of the earlier 6, with the slab breaks of 3 lakhs each. So 3 lakhs to 6 lakhs, 5%, 6 to 9 lakhs, 10%, 9 to 12 lakhs, 15%, 12 to 15 lakhs, 20%, and the maximum rate of 30% will be attracted for taxable income above rupees 15 lakhs. It is important to note the separate limits of rebate under section 87A, which will now be applicable for the old and the new schemes. Currently, rebate under 87A is applicable in case of both old and new tax regimes for a threshold limit of taxable income of rupees 5 lakhs. Effective AY 24-25, the threshold limit of 5 lakhs for entitlement of rebate has been raised to 7 lakhs, but only for the proposed new tax regime governed by section 115 BAC. Accordingly, the current maximum rebate of rupees 12,500 would stand increased to rupees 25,000 under the proposed new tax regime. In the package of Panchamrut, the 5 key reliefs announced by the FM in her personal income tax proposals, there are 2 significant reliefs. 1, reduction in surcharge, and 2, eligibility for standard deduction under the proposed new tax regime. The maximum rate of surcharge has been reduced from 37% to 25% under the proposed new tax regime, but it needs to be noted that the 37% surcharge shall continue if you opt for the old tax regime. Thus, the maximum income tax rate under the proposed new tax regime shall stand effectively reduced to 39% in place of the current 42.74%. Salaried taxpayers and pensioners were unhappy when, under the earlier new tax regime, their beloved standard deduction of rupees 50,000 in case of salary and pension income was stolen. Even standard deduction of 15,000 from family pension is currently allowed only under the old tax regime. Both these deductions shall now be allowed both under the old as well as the proposed new tax regime. And perhaps a big bang news in terms of an exemption being multiplied almost 8 times over is in regard to leave encashment. Taxpayers, particularly salaried taxpayers, will recall that the current exemption limit of rupees 3 lakhs in respect of leave encashment in case of non-government employees was notified under section 10(10)AA in the year 2002. At that time, as far as the government employees, both central and state government are concerned, their encashment entitlement was something within the range of this rupees 3 lakhs, and therefore, while they were granted the complete exemption, the notified exemption limit for the non-government employees was kept at 300,000. Over the years, the entitlement for leave encashment in case of government employees kept on increasing from time to time, and they were eligible to claim exemption for entire amount of leave encashment received by them on their retirement. However, the poor non-government employees were stuck up for the past almost 21 years. This glaring inequity between the government and the non-government employees in terms of their entitlement for exemption for leave encashment is finally proposed to be rectified by issue of notification revising exemption limit from the current rupees 3 lakhs to almost over 8 times rupees 25 lakhs in case of all non-government employees who get leave encashment on their retirement. Take a case, an employee who is retiring and would get his full entitlement would earn rupees 22 lakhs extra with a clear tax saving of 30% of income tax and cess thereon, and if applicable in his case, even the IT surcharge on the same. This is not going to be a small amount. I am sure this AMRUT-KAAL bonanza given to all salaried employees as and when they retire would for sure be remembered by them as a fond gift from the FM. In fact, long overdue. The cumulative impact of the proposed amendments under the new tax regime with the introduction of subsection 1A to section 115 BAC have proposed a threefold welcome change. Rise in exemption limit from rupees 2.5 lakhs to rupees 3 lakhs. Rationalization of tax slabs. The earlier 6 tax slab breaks of 250,000 have been now substituted with 5 slab breaks of rupees 300,000, resulting in a higher tax saving. And eligibility for standard deduction, both out of salary, pension and family pension as well. These changes as proposed in the new tax regime make it far more attractive in comparison to the old tax regime as also the current new tax regime. Let us start with a comparison of tax liability under old tax regime and the proposed new tax regime. In case of a salaried taxpayer getting gross salary of rupees 15.50 lakhs and claiming deductions and exemptions for allowances, investments and allocations to the tune of rupees 4.25 lakhs under the old regime, after the deductions his taxable salary would work out to 11.25 lakhs, on which the tax payable would be 1,56,000. Under the proposed new tax regime, on the same gross salary of 15.50 lakhs, after considering the standard deduction of 50,000, the taxable salary would be 15 lakhs, and even though the taxpayer has not made any investments or allocations or claimed any deductions or allowances other than the standard deduction, he would get the benefit of the same tax payable of rupees 1,56,000. This certainly adds extra liquidity to his pocket. As we saw earlier, under the proposed new tax regime, apart from individual and HUF, even an AOP would be entitled to take the benefit of the concessional tax rates. Here is a case study of a private discretionary trust created under a will and taxed as an AOP. Currently, under the old tax regime, the discretionary trust taxed at the individual rates of an AOP would be paying tax of rupees 2,73,000. Effective the coming financial year 23-24 for AY 24-25, on the same taxable income, the AOP also being eligible to get the benefit of concessional rates under the proposed new tax regime would end up in paying only 1,56,000. Thus, keeping in view the AOP being entitled to the proposed new tax regime benefit, it would reap a very healthy tax saving of rupees 1,17,000. Well, if you are perplexed about old versus the proposed new and you are groping to find a clue, keep in mind that for choosing the right tax regime for AY 2024-25 between the old tax regime and the proposed new tax regime, just take into account the tax differential where total income is rupees 15 lakhs or more. This will give you an idea as to what is that break-even or cut-off point for purposes of claiming deductions, so that it either remains tax neutral or the old or new can be beneficial for you. From the chart that is being shown to you on the screen, you will see that if the deductions claimed by an individual where his total income is rupees 15 lakhs or more, where deduction is within the range of 2 lakhs to 3 lakhs and 50,000, if the new tax regime is preferred in comparison to the old, you would save tax ranging from 54,600 to 7,800. So obviously your preference would be for the new scheme. The exact break-even comes at the deduction level of 3,75,000, where the tax differential is zero and you can go for any of the two schemes. But if your deductions are rupees 4 lakhs or higher, as you will see in the chart, the preference for the old would be more beneficial, because the new can make you sacrifice 7,800, 23,400 or even 39,000. In such a case, you might want to look at the old as your preferred choice. On an analysis of these case studies, here are some Guru mantras that you can remember so that you can make the right choice and rejoice. Keep in mind that where total income is more than rupees 15 lakhs, the break-even point of deduction is rupees 3,75,000. In case of a salaried employee, where total income is up to rupees 7.5 lakhs, the old tax regime would require planning of investments or allocations of rupees 2 lakhs over and above the standard deduction of rupees 50,000, whereas under the proposed new tax regime, no such investment or allocations would be necessary. And finally, while we wrap up this discussion on old versus new, let us take a look at the tangible tax relief offered by the FM in Budget 2023. As I mentioned earlier, unquestionably, what this budget has offered after a patient wait that the taxpayers had to keep for almost 4 years in a row, finally the FM has been so generous and large-hearted to make this AMRUT-KAAL budget with its PANCHAMRUT a truly historic budget. Just compare the tax liability for different taxable incomes under existing new and proposed new tax regimes. Bear in mind, this is the comparison between the existing new, the rates and the tax as applicable for FY 22-23 and the proposed new scheme or regime which will be applicable from FY 23-24. On income of 7 lakhs, under the existing new you pay 33,800, whereas as proposed you will pay 0 with the benefit of tax rebate with a clear tax saving of 33,800. This slides down to 10,400 at an income level of 8 lakhs, gradually going up to 15,600 at rupees 9 and 10 lakhs of income levels. At 12 lakhs, the tax saving works out to 26,000, and at 15 lakhs comes the peak of the middle class income taxpayers' tax saving of a whopping 39,000 for the full year. And of course, if you are a crorepati taxpayer, you can certainly rejoice, because as you will see, at income of 3 crores, you are saving tax of around 48,750, factoring the nominal surcharge that is applicable in your case and which is the same for both existing new and proposed new. But with the proposed new capping the surcharge at 25% and eliminating the 37% surcharge bracket on 6 crores of taxable income as compared to the existing new liability of 2 crores 52 lakhs 72,390, you will now pay as per the proposed new only 2 crores 30 lakhs and 10,000, resulting in a clear tax benefit of 22 lakhs 62,390. So that was unraveling all the confusion or misunderstanding that you may have been carrying in your minds post-budget about the old versus new. And as I conclude this presentation, I want to end with this positive message urging voluntary tax compliance of my dear taxpayer friends, one and all. we are truly in an AMRUT-KAAL of income tax payers compliance model, where earning income up to 7 lakhs, you do not have to even think about income tax. If you are earning around 9 lakhs, just about 5%, and even at income of 15 lakhs, friends, you are just about required to pay 10%. This is truly a golden era, a dream that many taxpayers of the best of the East and West may cherish. But then we have been offered that. Let us rise to return with our compliance for the benefit of the nation as we march on to India at 100.